Many people believe investing is only for those who already have money. They think you need thousands of dollars, a high-paying job, or years of financial knowledge before you can even get started. But in today's world, that's simply not true. Thanks to fractional shares, low-cost investment platforms, and broad market ETFs, it's possible to begin investing with far less money than most people imagine. Today we will talk about start investing with only $50, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. Change your mindset about investing. One of the biggest financial myths in the world is that you need thousands of dollars before you can start investing. Because of this belief, millions of people continue delaying their investment journey, waiting for the perfect time when they have more money available. The reality is that investing is not about how much you start with. It is about creating the habit of putting your money to work. Almost every successful investor understands the power of starting early and staying consistent. Your first $50 may not transform your life overnight, but it represents something much more important. It is the beginning of a mindset shift, from simply earning money to making your money grow for you. Many people spend years thinking about investing, but never take action because they believe their small amount of money does not matter. However, every large investment portfolio started with a first step. The person who starts with $50 today and continues investing regularly can often be in a much stronger position than someone who waits years to invest a larger amount. 9. Take advantage of fractional investing. In the past, investing in major companies was much more difficult for ordinary people because the price of a single share of a successful company could be very expensive. This prevented many beginners from entering the market. Today, technology has changed the investing world through fractional investing, which allows people to buy a small part of a stock or investment fund instead of purchasing a complete share. This means your $50 can be divided among multiple investments rather than sitting in only one place. Fractional investing has made the financial markets more accessible than ever before, giving beginners the opportunity to participate in the growth of businesses around the world. It also allows new investors to learn with smaller amounts of money, reducing the emotional stress that comes from risking large sums when you are still gaining experience. 8. Focus on low-cost index funds. One of the most common mistakes beginners make is trying to find the next company that will suddenly make them rich. They spend hours searching for secret investment opportunities and trying to predict which stock will become the biggest winner. The truth is that even professional investors often struggle to consistently predict the future of individual companies. This is why many experienced investors prefer low-cost index funds. These funds allow you to invest in a large collection of companies at the same time, reducing the risk of depending on a single business. 7. Stay away from get-rich-quick investments. The internet is filled with advertisements and social media posts, showing people who claim they turned a small amount of money into enormous wealth in a very short time. They show luxury cars, expensive houses, and a lifestyle that makes investing look like an easy path to becoming rich. However, what most people do not see are the thousands of individuals who lost their money following risky strategies, chasing trends, or investing without proper knowledge. 6. Use your first $50 as a learning experience when you begin investing with a small amount of money. Your biggest profit may not come from the returns you earn. It may come from the lessons you learn. Investing teaches you how financial markets move, how emotions can influence your decisions, and why patience is one of the most important qualities an investor can have. You will experience days when your investments increase in value and days when they decrease. 5. Make investing a regular habit. The people who build significant wealth usually do not do it because they invested one large amount of money at the perfect time. They do it by consistently adding money to their investments over many years. This habit of regular investing allows you to benefit from time and the power of compounding, where your money begins earning returns on previous returns. For example, Investing $50 once may not create a major difference in your financial life. But investing $50 every month for many years can produce much larger results. 4. Pay attention to fees and expenses. Many new investors focus only on how much money they can make and forget to consider how much money they might lose through fees. Investment fees may appear small, but over many years they can reduce the growth of your portfolio. This is especially important when you are starting with a small amount like $50, because every dollar matters. High transaction costs, management fees, and unnecessary expenses can take away money that could have remained invested and continued growing. 3. Think like a long-term investor. One of the biggest differences between successful investors and unsuccessful ones is their time perspective. Many beginners become worried when the market falls for a few days, or excited when their investments suddenly rise. These emotional reactions can lead to poor decisions, such as selling investments during temporary declines, or buying assets only because they are becoming popular. Successful investors understand that financial markets naturally move up and down. 2. Increase your ability to invest. While investing your first $50 is an excellent start, increasing the amount you can invest over time can significantly accelerate your journey toward financial freedom. One of the best ways to do this is by improving your income. Learning new skills, developing a side business, finding better career opportunities, or reducing unnecessary spending can provide more money to invest. 1. The best time to start is now. The greatest advantage in investing is not having a huge amount of money, it is having time. Time allows your investments to grow, recover from market downturns, and benefit from the power of compounding. Unfortunately, many people spend years waiting for the perfect moment to begin. They tell themselves they will start after receiving a better salary, paying off certain expenses, or saving a larger amount of money. The problem is that the perfect moment rarely arrives. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.